Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. Well, this time we're going to talk about payroll and what else is going on in the market, which frankly is not a lot. New numbers for CPI, inflation is slowly working its way down. Bond yields have come down a teeny tiny bit, from the 3-month to 30 years coming down in anticipation of the Federal Reserve lowering rates, September. Initial jobless claims. You look for drama here, and there isn't any. If you're going to go into a recession, generally problems start with either housing or jobs. And we don't have problems in either one. The chances of having a recession are becoming slim. We're not no way, but foreseeably, we're simply not going to have a recession. We're going to work our way through this and generate a soft landing, like everybody has talked about, for a variety of reasons. One, you look at payrolls, even from June 19th, the payroll growth, yes, there's been more money going through payrolls, that's volume in this, and more people, that's the count going through this. New jobs have been growing fine. This is not an employment market that's fallen apart. You look at when we were having all of this, the job openings everywhere. Well, that was bad data. A lot of duplicate ads and all kinds of things going on. As that stuff normalizes, we're down to kind of where we were. Not a lot of new job openings. People are finding jobs, especially those that are looking for them. Houses have not collapsed. Housing, if it really were to fall apart given to high prices, and I have to pay 7% for a mortgage, the drama of that. Well, the housing market is normalized down with what's available on inventory. There's still about 3.5 months worth of inventory. And the sales have not collapsed, they've sort of stabilized. The stock markets, which near and dear to our hearts, the blue down there, that's the Dow. And the black up there is the S&P 500, and the green, the NASDAQ, the small companies. They've been doing pretty well. S&P 500, well, that's all NVIDIA. And the NASDAQ has got a couple of other really high flyers. But the market is not finally, but is overbought. Too much money chasing too few assets, and it's overbought a little bit. And this triggers some problems, and this triggers some sells, which today NVIDIA is actually having let's call it a correction. Not really a correction. Last time I saw it was only down about 6%, but they don't have earnings yet, substantial earnings to justify their prices. So that's going to correct itself. The stock market is not in a bubble. The stock market is a tiny bit overbought. The stock market is right where earnings ought to be. It's not a bad place. And it's certainly not at a place that it's collapsed, so you're going to have a huge return here in the near future. It's just not in the works. Compared to what's going on in Europe, and Europe is really trying. The S&P 500 is clearly outperformed for a lot of reasons. That's not just the strength in the dollar. That's earnings and new companies and typical capitalism doing better than a lot of things that's going on in Europe. This also takes a lot of the wind out of the sails of the euro becoming an important currency in the globe. It's not. And if the political problems in France continue to get worse, it's going to take, the last chance of that ever being important. It is all the dollar. The yuan, no. The euro was the only possibility. The yen, no. It's becoming more and more the dollar. In fact, even around the world, this is just the bond market. All the U.S. corporates, just the corporates, not even the treasuries, coming from all over the world. I mean, we're talking $200 billion, $180 billion just in March. Well, the prospects are here, not anywhere else. And it's not like the United States is a shining, glorious star. It's the only game in town, and becoming more so. People are leaving places. Well, we knew they were leaving China and the UK and India and South Korea. Yeah, they want opportunities. Frankly, if you're on the lam or trying to get out of the financial system or have some tax problems, you go to the Emirates, United Arab Emirates, Dubai or Abu Dhabi, and some bunch of people going there, especially Russians. If you're not on the lam and want to play the game without being on the run, they come to the U.S. or Singapore if you're Chinese. Works out for them, and they just have to get away from the environments they're in. The Federal Reserve, and I know there's still a lot of conversation about when the Fed is going to lower rates and everything will be great then. I'll remind you again that I think the first opportunity that we're ever going to see for the Fed to lower rates is going to be September at the earliest. If they do, it's not going to be much. In fact, they've really come out and said, well, here is our neutral rate as we see it, and the neutral rate is where they're thinking the cost of money ought to be. Well, it's in the very high threes. We're at 5.25 right now. That tells me if they start lowering, they certainly aren't going down to zero, so don't keep thinking that. It will be a substantial amount of time before they get out of the fours. And then they're probably going to stay there. Remember, they want inflation at 2, cost of money at 3, maybe 3.5, mortgages at 5. You've heard that before. It's simply more official. So when they start lowering rates, it's going to be a glorious 3 or 4 days for the bond market, and they're going to have fun with it. But it's going to stabilize in a hurry, and then we'll be back to yield and quality. That has not changed. Nor is there any drama, nor is there anything that needs to be fixed in the way of a bubble. Finally, there was a question or two about, gee, isn't this horrible about property and casualty insurance? And well, this is historically where P&C coverage rate increases have come. And you go back to about 2000, 2002, we had some bad hurricanes. And the industry just absorbed that and threw a bunch of new rate increases. And they've had a few more. In 2018, there was a couple of problems. There was another storm. And then we had kind of a, well, the prices went down. Now they come way back up. Most of that is inflation, wildfires, so on and so forth. They're shifting. They're starting to shift their risk. There's a lot of counties in California that have learned that the hard way because you can't get coverage. Or if you have a house sitting on a beach someplace, especially in Narragansett, you're not going to get coverage. These rates aren't going to come down. We'll just have to get used to it, and it'll be part of the new inflation side of P&C coverage. That's really about all that's going on. We're still in the summer doldrums, but there's nothing to worry about. The stock market is doing fine, and after NVIDIA comes around and corrects some things, we'll see how the rest of the earnings in the S&P 500 get better over the next couple of quarters. As always, send questions along to info@SHJ Wealth Advisors, and I'd be happy to deal with it. Thanks for joining me.